Welcome to the Del Walmsley Radio Show. Del challenges the status quo, questions everything, and empowers you to return to your core beliefs to make your life better. If you're ready to hear the truth and get your roadmap to the lifestyle you really want, the next hour will change your life. And now, your host, self-made millionaire, national award-winning investor of the year, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to Del Walmsley Radio Show, where the hype ends and the help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. Today, my friends, someone had sent me an article that's really good. It's called The 10 Hard Questions Asked Before Investing in a Commercial Partnership. And it's just a really good article, and I was all set to prepare to work through the article today with you, and there's a lot of learning involved, a lot of good ideas in there. Then somebody sent me something that was just simple and easy, and it really made me start thinking that I had to get it on because it's so simplistic. Sometimes the most simplistic things in life are the most important. Many times the most complicated things are less useful. So the article that I wanted to show you is a very complicated article, has a lot of very complicated ideas in it, which I'm still going to come back to. But instead, I want to start the first segment by going through this other article, which is, here are 10 popular phrases you heard over and over again as you grow up. The problem is, quite simply, they're wrong. And I thought that was so cool because we have been brainwashed our whole life to believe the wrong thing. And we don't even realize we've been brainwashed to believe the wrong thing our entire life. Now, the ones here on this list are very simple ideas. But what I like is the idea that you can see from this list how many different false concepts have been shoved down our throats since we were a kid. So let's make some quick meters, see what we get through it here. Number 10, a penny saved is a penny earned. No, it's not. It's a penny. The problem with saying that it's linked to income is that it's too small to matter. Nobody gets rich saving pennies. Well, that's not even the real problem. The real problem is a penny saved is not a penny earned because savings do not earn anything. A more correct statement would be a penny invested correctly could be a penny earned. Yes, you could earn 100% return on that penny and or that dollar or on that 100,000 or on that million. But you can't do it by saving. Savings get you nothing. It's always made me curious as to why people think naming their money makes it produce any more income. So I'm going to call this my 401k. I'm going to call this my IRA. I'm going to call this Billy's college fund. This is our savings fund. This is our rainy day fund, this is our fire fund, this is our vacation fund. All of those places you're sticking money is just simply money. What you really need to ask yourself is, what percentage of all of your net worth is invested in something that produces income for you, and what is that income? And the reality is, when I do this in my seminar, 99% of the people earn less than 1% return on their net worth. 99% earn less than 1%. That's pretty hard. It's not hard to believe. It's harsh reality is what it is. That people are earning nothing. Because why? Because they've been taught their whole life a penny saved is a penny earned. Another one is fly under the radar. The guy goes on and says, no, you want to be known. Nobody will do business with you if they don't know you. That's like people out there who let their properties be ugly and dirty so the tax man won't think it's worth more. So nobody will come around and pay attention to what they're doing. It's like people who own their own personal businesses and they write off all kinds of bogus expenses to make sure they have no income. And then when they have no income and they want to go to the bank and borrow money, they can't. They're flying so far under the radar that they don't have any credibility to do anything with anybody. You know, you go out there and go, why is it that some people can come into Lifestyles and get 5, 6, 8, 10, 15 deals right away, and other people sit here for 6 months before they get their first deal? It's all about not flying under the radar. You do not want to fly under the radar in life. You want to stand out so people will see you, so people want to do business with you. The next one is number 8 is buy a house. This is not the way to wealth. A house is not wealth. Building investment because it doesn't pay you money every month. You pay it. It doesn't pay you. Right on with that one. A house is consumption. It's not an investment. Sometimes houses go up in value. Sometimes houses go down in value. That's just gambling, That doesn't really matter. But the house is actually consumption. It's not an investment. So there's a very large portion of your total net worth wrapped up in consumption as opposed to investments. Number 7, be patient. If patience is a virtue, then urgency is divine. The average age of a millionaire is 62 years old. Who wants to wait that long? Don't be patient, folks. I totally agree. I retired at 34 years of age. Being patient is not the right answer. The long, slow way is not the way to go. You've got to get it and get it done now. Rule number 3 in my life is you can't get rich slow. You got to get out there and get it done and make large amounts of money. Number 6, don't talk about money. It's no wonder that people don't have money if they're not something they can even discuss. Meet weekly with your family and friends to talk about money. Biggest thing you'll hear about lifestyles. If you listen to this radio show long enough, you come to our events, thing that everybody's surprised about is that we all talk about money. We talk about our money, somebody else's money. We talk about how we can get more money. Because we focus on money, money is attracted to us. People who hide what they have and what they do end up poor. You've got to talk about money if you want money in your life. Number 5, eat everything on your plate. Why? Is the guy's answer. Will you get rich stuffing yourself? I always leave food on my plate. And, he says it's the abundance mentality that there's plenty. I don't need to eat everything on this plate. There's plenty of food out there. I don't need to eat everything on this plate because I can afford to leave some of this food. The abundance mentality, it's very important. I had to learn that myself when I was a kid. I was a fat pig because my parents made me eat everything on my plate. It became my way of seeing food. It was like, oh my gosh, if there's even a crumb left on somebody else's plate, I need to get to it. And I had to change that. And now, quite honestly, I go out to restaurants and I leave food on my plate. So, I'm just full. And sometimes we'll take it home, because it's the kind of stuff that would reheat really well and taste good a second time around. But a lot of it you can't take home. It's just not worth it. Many fish plates and stuff. I never take the fish home because it never tastes good the second time. So again, the abundance mentality. Don't feel like you're starving or you will be. Number 4, get a good education. This is why so many people go into massive debt. They find themselves still unable to get high-paying jobs. College will not teach you how to get rich. I agree college doesn't teach you how to get rich, but I don't believe that getting a good education is the bad thing. The key is get a good education on that which you want to do. So don't go to generalized college and get 47 different classes of stuff that you'll never use in your entire life. Where is African history going to help you? Unless you're going to go to Africa and you're going to be someone trying to communicate with Africans about business in some way, shape, or form. You need to know their history. You need to know their language. Then all that makes sense. But if that's not what you're doing, if you're going to be a stockbroker, you don't need to know all that stuff. Whatever it is you're going to do, you need to have specific education. Number 3, don't blow your own horn. Boy, that's about as wrong as can be. The people I see are successful. They do blow their own horn, not in an egotistical, arrogant manner, but they get out there and they let people know, this is where I'm going. Do you want to come with me? Leaders go places no one's ever gone before and send back maps. This guy says, Muhammad Ali told the world he was the greatest even before he was. Likewise, I'm not afraid to tell everybody I'm a great salesman in the world. Blow your own horn. Like I said, within reason, I think you have to blow your own horn. I have to talk about lifestyles and how we've won the National Apartment Association's Investor of the Year Award 12 years in a row. Yeah, that's blowing my own horn, blowing our horn, but you have to do it with respect of everybody else. Next one, set reasonable expectations. Stop settling and stop lowering targets. You want to dream big. with high expectations. So as you go out there and you see people that are not dreaming big, they have low expectations, they end up with low results. The last one, when we come back, I'll share with you on the other side. We'll be right back with the Del Walmsley Radio Show. Welcome back to the Del Walmsley Radio Show. Today we started the first segment with 10 things you've been told your whole life that turn out to not be true. We're down to number 1 right now, and I saved it for this segment just to be able to hold it over and get it covered clearly. And the statement is, don't talk to strangers. Wow. Can you believe telling your kids that? Don't talk to strangers. This guy writes, the truth is strangers have everything you want. Who's got your money? Strangers. You must learn to talk to new people in order to expand. I will say unequivocally, the people that I've seen get rich the fastest in front of me as I'm watching, as I'm tutoring, as I'm teaching and mentoring, are the people that have networking skills. The ability to go into a group of people and to learn people's names, to remember their stories, to make friends with them, to connect and network is, in my mind, the number one most important skill set necessary for someone to be successful, bar none. So if you can't do that, you need to work on it. And I had to work on it. It wasn't natural to me. I went to a class, Dale Carnegie class on public speaking. I didn't need to learn how to speak publicly. What I needed to learn how to do is win friends and influence people, which is one of the books that we were made to read. And in there, it talked all the way through the whole book about how you have to be able to communicate with people. And I'm not going to do the whole book. I probably should do the book one day. That's a good book to go over. But the concept, of communicating and winning friends and influencing people is the most important concept there is out there in business today. I guarantee you, bar none. Now, I promise you we get onto a technical article for those of you who are technical people. And this is a pretty interesting one. It's called 10 Hard Questions to Ask Before Investing in Commercial Real Estate Partnership Deals. And the guy goes on and has a dissertation, which I agree with, which is that the problem with getting into these partnership deals, these syndications as we call them, is that a very large percentage of people putting these deals together are ripping off the people investing in their deals. They're ripping them off as to what rates of return that they're allowing the passive to have and what they're taking as what I call the lead. Other people call it the solicitor, the guy selling the deal. And usually they take all kinds of money out of these deals. So we're going to go to these things. There are 10 good questions to ask. And then I'm going to try to see if I can give you any insight as to how we handle them at Lifestyles. The first one is, how much is the operator, person managing the deal, investing personally? Okay? And it comes down to many of these people putting these deals together put nothing into the deal whatsoever. Nothing. We at Lifestyles have a set of rules we all agree to follow. And the rule is the guy starting the deal has to put up on his first deal at least whatever percent of whatever it is that they're going to raise. So if they're going to raise $1 million, they got to put in $250,000. It might be 15 on the first deal, 10 on the second deal, 5 on the last deal. I need to look that up because they did work the white paper over and change some of the rules, and I need to be clear on that. But the bottom line is we do have a requirement that a first-time lead has to put in, let's say it's at least 15% of the down payment money. It used to be 25. I think they've changed it. But the point is they had to put up some money or they couldn't put the deal together. The second deal, they still had to put in at least 10%. And the third deal, they had to put in 5%. And then after that, if they had that much experience and people had not, they had shown and proved that they could handle these deals, then at that point, they didn't have to have skin in the game to make it possible for them to move on. The second thing it says that you should ask is there a huge upfront fee or load? Man, this is one rule here at Lifestyles. We just don't allow what happens in most of these deals, I'll give you an idea, is that they take a commission for brokering the deal. So out of your proceeds, the money you bring to buy the deal, you're paying a real estate commission, probably as much as 4 to 6%. Then you've got somebody that's an asset manager that is being paid to manage the partnership, and they're getting paid something. You're getting a rehab construction person who is getting paid to manage the construction. And many times they're all the same person, by the way. Somebody else is getting a loan origination fee for getting the mortgage. Many times, again, all part of the management team, all part of the same person, taking all that money out up front. Sometimes they just take an override. And like in Lifestyles, we have a limitation. The first time you do a deal, you can't take more than 5%. Second time, you can't take more than 10%. Third time, you can't take more than 15%. Then after that, you can take up to 20%. Some of these people are taking 50% of all the profit right out of the blocks. You've never even done a deal with this guy. He's taking 50% of your profit, plus he's sucking all the money out the front end of the deal. These upfront fees and loads, right, are extremely dangerous in these deals. They're what makes sure that the passives almost never succeed compared to Lifestyles deals where we don't allow any of that kind of stuff. Question number 3, what is the exit strategy? When you ask the question, you're asking, how will I get out of this investment? It's not an unreasonable question. Do not invest in any estate funds that present no clear-cut exit strategy for their investors. There are only 2 investors that can get taken out of any commercial real estate deal. One is a refinance and the other is a sale. Only 2 ways you can get taken out. Now, when you refinance, you're taking money back out, right? And you may get all of your invested capital back out by the refinance, but you should still end up owning your share of the profits. The only way to really get all of your money back out, because you still have equity in the deal, the only way to get all your money out is to sell the property at some point. And you have to decide up front, how long are we going to hold this property? They need to be able to tell you that going in. If they're going to sell it, are they going to do a 1031 and move into another property so you don't pay any taxes, or will there be taxes to be paid at the end? You need to know all that stuff. You need to ask those questions. It's imperative. Legally, they're supposed to give you all this information on a document. To be able to raise capital, you have to use a private placement memorandum and give people the information that we're asking right here that everybody should know before they get into a deal. Number 4, how many smaller investments do they have? When managers or operators say, well, we have taken $50,000 as a minimum, but I'll let you in for $10,000, that usually means that they are desperate. They may be raising a lot of money. By pulling the wool over their investors' eyes about what volume the investment capital they need, this is not the same as a manager who says forthrightly, we would prefer $50,000, but we would take 8 investors at $10,000, or we'll set a minimum of $10,000. Why it matters? If the managers thought they could get enough investors at $50,000 and then have been unable to do so, that may indicate trouble somewhere. Ask yourself, why? Why can they not raise the capital? This is so true. We see people that leave Lifestyles and they think, I don't want to follow the rules anymore. And here at Lifestyles, there's so many investors that are, educated and financially well off that they're ready to get into a deal instantly. These people leave Lifestyles to go outside in the real world, and it becomes almost impossible for them to raise capital. Almost impossible. And you'll see it. They'll start out saying, I need $100,000 minimum. Then they'll drop to 50. Then they'll drop to 25. And then they'll take whatever they can get. That's just the obvious point that these guys don't know what they're doing and that you should stay away from them. We're going to take a short break. Be right back with the rest of this list and a few items we want to cover today on the Del Walmsley Radio Show. Welcome back to the Del Walmsley Radio Show. Today we're covering an article, 10 Things You Need to Ask Before You Get Into a Solicitation. One of these partnerships deals, it's actually a solicitation, syndication for apartment deals. And this article's got some good questions to be asked. And here at Lifestyles, we make these types of questions available. Our passives are able to ask the leads these questions right up front before they even decide if they were interested with the deal. And it makes it so much easier if you can get the information right up front. Now, the information should also be in the PPM, Private Placement Memorandum, and it's important that you ask all these questions. For those of you who just tuned in, the 10 questions that we asked is how much is the operator or the managing partner putting in the deal? Number 2, is there a huge upfront fee or load? Is the lead, or I call them leads, they're really they're syndicators, How much are they putting in the deal? Do they have skin in the game also? Question number 3, what is the exit strategy? How do you get your money back? How do you get out of these deals? Some of these deals have lifetime perpetuation. You never get out. Number 4, how many smaller investors do they have? In other words, how many people have they slid into the deal because they didn't have enough money to get it done? They couldn't raise the capital because their offering is a poor offering. It's either it's unfair, and people that are smart enough reading it are saying no. And the only people that will say yes to this type of an offering are people put very small amounts of money in, which means they're unsophisticated. They don't really know what they're doing. If you have a great offering with a great general partner, solicitor, I call them lead investors. That's my nickname for them. It's not a actual dictionary type word. But the guy and gal putting the deal together, right? How much are they taking out of the deal? Where are they taking it out, right? Those are things that you need to know. And how many smaller investors means, were they able to raise capital? If you have a good lead investor, they should be able to raise capital instantly because they've already got people that know them, that have seen the results, that are ready to take action, waiting for action. And as long as the deal makes sense. Now, if the deal doesn't make sense, or the lead doesn't have a reputation, then the only people who will be interested in investing with them are going to be people that are unsophisticated. And that's why this question number 4 here is asking you, are there a bunch of unsophisticated people putting very small amounts of money in the deal, which tends to play out that the guy or gal putting the deal together doesn't know what they're doing? The next question is way more complicated. I don't know if I can even do it justice, but it says, where does the money go? And literally, you should be able to, as the syndicator of the deal, lead investor in my terminology, you should be able to give your partners, your investors, they're not really partners, but investors in the deal, an exact analysis of where that money's going. Up front, this money's going for loan origination fees. This money's going for setting up the company. This money's going for security deposits, for property taxes and insurance. This money's going to pay the first year's insurance. This money is going to buy our software licenses that we need, et cetera, et cetera, et cetera. You should be able to give them a list of where all that money went that was spent up front. This money's going for our down payment. This money's going into a rehab account that we're setting aside this account for money as we do rehab. This money is going into a negative carry account where we realize we're going to lose money for a while. This money is set aside to carry us while we're in negative carry. You should be able to identify exactly where all the money's going. If someone does a deal with you and they don't tell you where the money's going, then how do you know they didn't just stick it in their pocket and the company's broke? You just don't know that. In fact, I don't even think he has it on here, but you should be able to get up front the financial statements on the deal. What is it going to be like? What is the pro forma of the deal going to do? How much money are we investing? What is our cash flow going to be? And what should our expected returns be? Now, they can't be accurate 100% of the time, right on. That's not realistic. But they should be close. I mean, if they know what they're doing, they should be able to, within reason, identify what's going to happen. They know what it's doing the day they buy it. They know what changes they're going to make. They should be able to calculate what that is going to turn into as far as cash flow. So, know where the money goes. Number 6, what is your operator's experience? Think about that one for a second. What have they done? Have they failed? I know syndicators who have failed on deals. I know of, for sure, a guy who is a national multifamily mentor who the first 2 deals he did here at Lifestyles, he did terrible. His partners kicked him out of the deal. He was a terrible syndicator. Yet he's gone on to become a mentor of syndicators. Man, you got to find that stuff out. You got to check people out a little bit before you go giving them your money, right? Let's see here what he has down here. Did the operator ever do anything tangible with real estate? Were they entrepreneurs beforehand? Do you have personal experience with the type of project? What kind of financing background does the project have? Where is the asset located? And in my experience, the right thing to do professionally? Those are pretty ambiguous questions. I really think you got to look at the guy. You got to look at them. Firstly, what is their credit like? Credit is not a word. Credibility is a word. And living up to one's promises is what credibility and or / credit is. So if this person's making you promises and they've got bad credit, obviously they've not kept their promises in the past. Number 2, what is their associated skill sets? Do they have any business skill sets behind them at all? Marketing, sales, construction, personnel, hiring and firing. You know, the people that we've had come in here and do really the best job with apartments are people coming out of the headhunter field. Their job is to go find very, very good people jobs. Well, what skill do they have? They have the skill of being able to identify the right people for each and every job on the apartment complex and the right people as far as the leads that they should follow or the passes they should put in their deals. That's a very high skill set. The next one after that skill set that would probably be most beneficial is going to be marketing and sales, because what do you think the apartment business is? It's marketing and sales, 100%. And then the third one is the relevance of construction and knowing the cost of everything and knowing how to get things done effectively. Project management's a good associated skill set where you're given a set of things to get done and you get them done in a timely manner. These are the things you got to look at. Now you look at, does the guy have any money in the deal? Does he have any net worth? The guy has no net worth at all. You think about it. How can a person help you become rich if they weren't able to even create a net worth of their own, of some amount? I'm not saying they have to be rich to start, but I'm saying you got to look at that and say, how much am I willing to invest with a guy who doesn't have any money himself? Doesn't make a lot of sense. I used to hear it all the time, people. You know, let the poor people go do all the work because they don't have any money and the rich people invest. Gosh, that's absolutely backwards. Let's let the rich people invest because they know how to make money, and let's let all the poor people follow along and learn. Number 7, are they overpaying for the asset? This is something you're going to have to know real estate. You are going to have to understand real estate well enough to be able to look at the assumptions that the seller's making, to be able to look at the deal, to analyze it, and decide whether or not they're paying too much for this property. If you don't have that skill set, then you are at the mercy of this syndicator to tell you whatever they want to tell you. And syndicators are notorious for overpaying for properties compared to independent owners. I've gone after properties now for 2 years, Class A properties, and every time I get there, I bid absolutely right up to the very highest amount you could bid to make any sense at all. And I get beat by some syndicator who's raising hundreds of millions of dollars and needs to place it somewhere and will pay anything to win the bid just to place the money because they make so much fees off placing the money, so much fees off owning the real estate and managing it, that it's in their best interest to not even care if the property's profitable or not, to not care if they're overpaying. And they don't care. And they do overpay, and you end up getting taken advantage of because of that. So if you don't understand that, then you need to get to lifestyles or don't get into these deals. Because if you don't understand that, that is the core to being able to be a passive investor. Get into lifestyles, learn how to evaluate these deals. As we get to the end here of this segment, I've got really 3 more to cover when we get back. In the last segment, we'll finish this up for the day. But keep in mind, when you're out there, do your due diligence on the lead investor and the deal. They're both important. We'll be right back. The Del Walmsley Radio Show. Welcome back to the Del Walmsley Radio Show. Today we're talking about the 10 questions you should ask before you invest in a syndicated deal. We're up to number 8, which is how much leverage are they using? You need to look at the loans that are going to be used and need to make sure that the property is not over leveraged. Many of the deals that I've seen go bad I'd say probably most of the deals I've seen go bad, but many of the deals I've seen gone bad during the recession, during the time when real estate values got crushed, is when the deals were over leveraged. At one time, you could get an 80% first lien, and then you could get a 10% second lien called a mezzanine loan. And these guys were leveraged up to 90%. When the market adjusted, they were not able to get out of that 90% financing. All of a sudden, the financing would only lend 65 to 75%, and 75 had to be reviewed. You had to get a special clearance to get 75%. So these guys were stuck in these loans, and as these loans came due, they couldn't get out of them. There was just no way, and it ended up zapping them. So you need to look at that leverage. The healthy leverage situation in today's marketplace is 65 to 75%. I've not seen a lot of 80% financing out there. It's out there. Don't get me wrong. I know it's out there. But the stuff that I'm doing, that I'm looking at leverage 65 to 75% is the typical leverage that I feel comfortable with. If there's a lot more than that, you're taking on a lot more risk. Number 9, what other assets does your operator currently have? That's a good question. And it goes back to the point that I made earlier that on the pro and the con. The pro is that if they have no assets at all, and this is their first one, they don't have the experience or the skill maybe to make it through tough times. The con on the other side is if they've got quite a few properties, the question is maybe they don't have enough time and attention span to take care of the one you're getting into. So if somebody has quite a few properties, you need to be able to go look at those properties and see their financials and see if they're successful, if they're healthy. We do that at Lifestyles. We take people around to our investors' apartments, show them the apartments, show them financial case studies on the deal, how the lead did, what they did, what the numbers look like, so that our members, our passives, have an opportunity to look inside of the lead investor's business model. Without seeing inside of a person's business model, or at least having known about his previous investments and how they did, it makes it almost impossible for you to be doing anything more than flipping a coin. I'm right now myself doing a bunch of passive deals. I'm going to look at a couple apartments for sale today for myself, but I'm doing IRO, independent ownerships, and passives. And I'm looking at the passives and I'm evaluating the lead more than anything else. If I can go to the lead and know this lead's done several deals, they've been successful, then I'll look at the deal and see if the numbers and the property and so forth are worthy of what I'd be willing to invest in. But number one, most importantly, I'm looking at the lead investor. Who is the lead investor? Have they been successful in the past? And do they have any properties that they've already done? And so on. Last, let's see what his 10th question is here. Number 10, do they have partners? I don't even know what that one means. Let's take a look at what he has to say. If yes, do they have a partnership agreement or a document that clearly defines your working relationship? Don't hesitate to probe your potential operators until you get the satisfactory answer concerning this question. What you want to hear, the best case scenario is a couple of experienced operators working together after a long time off. The last thing you want is a bunch of folks who haven't worked together before. And husband and wife teams are red flags too. Interesting. Let me go through this and see what I think about this. First of all, the husbands and wives. We've had quite a bit of success with husbands and wives teams. I don't know why. I would think that would be a red flag also myself, because usually families don't work together that well. But what I've found is the successful husband and wife teams is where one member of the family is really operating the property, and the other member of the family is out doing acquisitions and so forth. So I've not had a problem with family member situations. Having a couple people working together are good. That is a good thing. I see that some of our top investors are going back now and being co-signers with other beginner investors. They call them key principals, and they're lending their net worth and wisdom to the deal. Now, the challenge is, and I've had this conversation with people, is that sometimes they're just doing it for the extra pay, and they're not really willing to lend their expertise to the deal. They're not even interested in the deal. It's just something they're doing to get a higher rate of return on what their investment is in. Two people that have never worked together, I totally agree. You take two people who never worked together and you put them in a business together, you got very high odds it isn't going to work. I mean, personalities clash. Ideas clash. And I have a saying here at Lifestyles, anything with more than one head has to be a monster. And in the past, we had rules that you could not have co-operating partners. We still have that as a rule. You can't have co-operating partners. But what the attorneys want put in place and what the mortgage companies want put in place many times is a backup co-operator. That in case this co-operator goes down, there's somebody invested in the deal that knows what's going on, that can instantly take over in case the lead gets killed in a car accident, an airplane crash, gets sick or whatever. And in that case, they want to make sure there's somebody to take it over. Well, my friends, I hope these 10 questions have helped you glimpse into the idea that you can get into deals that can go wrong. And what you need to do is do your due diligence on both the lead investor and the deal before you get in. Hope you have a great day. Remember, it's not the money, it's a lifestyle. See you tomorrow.
The information and opinions you hear on the Del Walmsley radio show are those of the host, Del Walmsley, his guests, and his callers, and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Del Walmsley show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.